this week's edition of On the Money with Secure Money. I'm Rebecca Powers. I'm your host each week, and usually we have Brian Quaranta with us. Brian he's the CEO and founder and president of Secure Money Advisors, and we always want to start off every show by telling you that he's also a published author, and we want you to go on onthemoneyoffer.com, and you can get a copy of the book absolutely free. But the perfect pitch hitter in again this week for Brian, our senior financial advisor, Neil Major. Wonderful to see you, my friend.
Oh, great seeing you, Rebecca. I'm happy to be here. And I think, you bring it up, the book is a good place to start.
Yes.
Because, I meet with hundreds of families each and every year. And I think, the book is a really great place to start because so many people come in and say, gosh, I was able to breeze through that book and I got so much out of it. I actually read it, one, and I think that's nice too, Rebecca. We actually send you a physical copy of the book,
right,
as opposed to an email that gets lost in all your other emails and you never read it. So this comes to your door.
Yeah.
You can flip through it and read it and talk about the focus of a retirement plan and how you have to shift from an accumulator to a retirement plan. And he does a really, really great job. But Brian's also done a really great job, Rebecca, at developing great systems and processes for us as advisors.
Good point.
And what he's done there is been able to simplify the process for people to be able to understand that their retirement doesn't need to be complicated. They don't need to get handed a pie chart that says they're in some large cap, some international, some bond funds. They don't care about that. They care about the outcome. And that's what I think what we do so well, and that's why we offer you to come in, read the book, come in, onthemoneyoffer.com, can get you there. Just go to the website, click to get the book, click to schedule an appointment.
And we've said it many times, but in Brian's book, he also gives his personal story and talks about how he used to be with one of those big boxes and how anti-personal it was, and how when the stock market went down, they would sit him on the phone and say, oh, your money
in there.
Yeah, hang in. Yeah, exactly.
You're in it for the long haul.
Yes. Yeah. Hang in there. You're in it for the long haul. It's just a paper loss. He said that. So this is literally his pet peeve and how he kind of created his philosophy of keep it simple, stupid. It's not brain surgery. Do you agree that Wall Street tends to speak over our heads so people are scared almost to go to their advisors?
I love it. That's a great way to put it, right?
Yeah.
Make things overly complicated so no one understands, so they don't really question anything. And I think Brian's got one of the greatest stories ever because he graduated from college in 1999, got right with the big box firms. In his first 3 years in the industry are 2000, 2001, 2002. And he's dealing with people that are either headed to retirement or in retirement. And, the big box firms saying, hey, we got a diversified strategy for you. We ran all these Monte Carlo scenarios for you. And with 95% chance you're going to be successful, 97% chance you folks are going to be successful. And then they're handed some booklet that most people never pick up again. But what he said is after his experiences first 3 years, people were running out of money. Diversification is not a retirement strategy.
Yeah.
It's just diversification, and that can fail you too. And so the way that we plan was really developed by what he learned at a very, very young age. And I think people appreciate the certainty that we can provide in their retirement plan.
I love it. All right, certainty is what it's all about, taking the stress away, taking the guessing away, and it all starts with a plan. Let's take some more of your questions, Pittsburgh. Thank you so much. This is from Newcastle. Mark is 64. His wife, Michelle, is 61. They say, we're concerned about RMDs pushing us into a higher tax bracket. Very smart. How do we manage that? Again, that's part of the plan that ends up in a beautiful binder for your family.
Yeah, so, we talk about the coordination of a plan, right? And the coordination of a plan is not just focusing on how the investments are performing, right? The coordination of the plan is understanding taxation, because if you're earning 10%, but you're giving it right back by paying 10% more taxes, how did that actually help you? It didn't, right? And so I like their question because they're thinking.
Yeah.
And they're thinking about things that come up. A lot of times people don't think about things until they happen. And sometimes it's too late to even do any sort of planning to help them. And so I like that they're thinking about that. So here's one of the ways that we want to understand, RMDs, right? So we want to understand your income strategy first. So we always say everything needs to coordinate. So we want to understand your income strategy first. So for our income strategy, we know how much you're going to need to withdraw from your investments. And if we're withdrawing it from your retirement accounts, we can have a projection of what those RMDs are going to look like when you hit the age of 73 or 75, whatever your RMD age is. So we want to understand what that potential RMD is, because if we don't do that, maybe you are forced into large distributions, which is going to impact your tax rate, which also, a lot of people don't know this, Rebecca, it also can impact your Medicare costs.
Higher costs.
Higher costs. I've had people come in and say, Neil, we're getting taxed to death on our Social Security.
Yeah.
I'm saying, well, what do you mean? I don't understand. You pick the tax rate on your Social Security. And then they'll tell me about how maybe they took a large withdrawal from their retirement accounts. Maybe they're an RMD age and weren't anticipating such a withdrawal. And now all of a sudden they're paying $600 a month in Medicare costs. Medicare comes directly out of your Social Security. So their Social Security check goes down and they think they've been taxed higher. They are technically just in Medicare.
But if they had had a plan till they're 95, I believe, you map out a plan.
If you have a plan and you can start to look at the taxation along with your income, you can start to do some things to strategize so you're not hit with a huge tax bill or Medicare bill when you get there.
All right. And Brian also talks about that in his book, Right Track Your Retirement. If you'd like a free copy, no strings attached, we promise. It shows up in a gold envelope. And we really love it. You say it'd be great to read the book first, but you can also get an appointment. It's complimentary.
Yeah.
Talk to me quickly and send us into break about how you do a third-party report. That's very eye-opening. You find out someone's risk and what their actual fees are, because you can be feed to death.
Yeah, and I think the book's a great place to start, but it's not, if you're not a reader, don't hesitate to just schedule an appointment with us. It's a no-pressure complimentary meeting. And what we really want to be able to provide to you is a second opinion, right? Because if this is all you've ever known or done, you have no idea if your advisor is doing a great job or a poor job. And so what we want to do with you is get into the weeds, run a portfolio analysis to understand the risks that you're taking. We want to understand the cost of the portfolio, the fees of the advisor, right? Those are important metrics to understand, because just because person A and person B both got a 10% return doesn't mean that they're going to lose the same amount of money in a given year. So those metrics are important. What are you doing to prepare for things like required minimum distributions? How are you planning to pass this money in a tax efficient manner? Do you have the right investments to last the rest of your lifetime? So our strategy when you come into the office is just to understand how we could potentially help you, run some analysis, give you a second opinion. And I think that's really, really powerful, because the number one compliment we get is, why has no one ever made it this simple to understand?
I love it. All right. If you are craving simplicity, go to onthemoneyoffer.com and we'll be right back.
One of the biggest challenges people face when planning for retirement is simply knowing where to start. Over the years, I've sat with countless families who felt overwhelmed by all the information out there. And that's why I wrote my book, to cut through the noise and give you straightforward strategies to protect your money, avoid unnecessary risk, and build real financial confidence. Inside, you'll find step-by-step guidance on how to structure your retirement income, how to prepare for rising healthcare costs, and how to reduce the impact of taxes. It's not about complicated theories. It's about clear, actionable steps that anyone can follow. And here's the best part. I'd like to send you a complimentary copy of my book. No cost, no obligation, just real information that could make a difference in your retirement. This book has helped thousands of people better understand how to secure their financial future. If you're in that 5 to 10 year window of retirement, or you're already retired and you want to make sure you're not missing something, this book is for you. Call Secure Money Advisors today or visit us online at securemoneyadvisors.com to claim your complimentary copy today.
Welcome back. All right, continuing to take your questions, Pittsburgh. Neil, this is from Craig and Sheila. They live in Bethel Park. Thank you so much for watching and writing this to us. Their question is, how do we ensure our income adjusts if inflation rises more than expected? Great question. Smart people out there.
Yeah, I love that question. It's a very wise question.
Yes.
And, we talk consistently about developing an income strategy, right? And when you develop an income strategy, what the focus is that you don't want to lose money when you're withdrawing money, right? We know technically the market, if you look at a historical chart of the S&P 500, it goes up permanently. The challenge is it goes down temporarily. And when you're in income distribution phase, those losses matter. So we want to take a bit more conservative approach on our income strategy. Now, what we don't want is all of our eggs in one basket, right? We still want growth potential in our portfolio. Yeah. We still want stocks as part of our portfolio. The difference is when we build in stocks as part of our portfolio, our income bucket, our green, as we call it, our green bucket, is going to build us time. That time enables our stocks to grow. We are a fiduciary, independent firm, right? We don't have to use, nobody's pushing products that we have to use down our throat. We can do whatever we think is what's in the best interest of the client. And truly, Rebecca, that's the definition of a fiduciary, right? The definition of a fiduciary is we have to always do what's in the best interest of a client. But let me throw this out. If I worked for XYZ big box firm and you wanted something that was guaranteed and predictable. Let's say we bought a guaranteed interest rate account and XYZ big box firm had a 4% guarantee, and I knew the guy across the street had a 5% guarantee. But I work for XYZ big box firm. I can't use that product across the street. Am I really acting in the client's best interest? No, of course not. That's why it's so important that we're independent.
It is.
Because nobody's telling us what we have to do.
It's such a great point, Neil, because there's no inherent conflict. So if you go to buy a car at Ford, they'll show you every Ford, but they're not going to say, go check out Toyota.
Great example.
Or,
Great analogy, for sure. Yeah, and a lot of these questions too have focused around tax planning, right? And a lot of times what we'll hear is, well, my advisor is not allowed to do that.
They say, go see your accountant.
Go see your accountant.
Yeah, that does me no good.
And there needs to be a coordinated strategy between the advisor and the accountant, right? Because the advisor needs to understand the questions. The accountant has the software program, which is powerful, but we can't just send you back and forth. That's not helping anybody, because you'll end up just giving up because it's too complicated.
It's too complicated.
So our focus is, we want to develop the tax planning strategy, and we really go to the accountant just to confirm our numbers through their software program.
And it's such another great point. You made me think of CPA as a history lesson, right? They look over the last 12 months, they do your returns. Tax planning is quite the opposite. Explain the vast difference.
Yeah, so a lot of times people think tax planning is done till April 15th. In our world, most tax planning ends on December 31st, right? So if we're coordinating a strategy for tax planning, it's got to be done by December 31st. Now, right before I came here, one of the things that we do each and every year for one of my clients, and they were in the other day, is something called QCDs. QCDs, a qualified charitable distribution. You're eligible to do this at age 70 and a half. And what they were doing, Rebecca, is they were giving to their church every week. Very charitable. Each and every week when they went to the church, they were given roughly $200, $250 a week, and they were having to pay taxes on that money. Because of the standard deduction, they weren't able to write it off anymore because they didn't have enough deductions. And so what we were able to do is send the church directly from the IRA $12,000, never touched their hands, went directly from the IRA to the church, tax-free.
Beautiful.
Tax-free. And so when you're thinking about coordination of an entire plan, right, you can't just focus on the investments. That's not a strategy. And a lot of times people come in, they have statements and they think that's a strategy. That's not a strategy, folks. It's focusing on the 5 key areas we talk about to death: income, investments, taxes, healthcare, and legacy.
And look, taxes are on sale. You know, it's so much better to pay on the acorn instead of the oak tree. Taxes are historically low.
Yeah.
I want to mention righttrackmytaxbill.com because this is another free tool that Brian and his team came up with, and it truly helps you understand what might my ticking tax time bomb be in my 70s. How do you use it, and how long does it take?
Yeah, so it's a good way to put your pre-tax investments in there and get an estimated tax return, and then what potentially your RMD is going to be and what you'll have to pay over that period of time without any tax planning, right? Now, tax planning is going to be different for each and every person that comes into the door, right? And, you know, we hear a lot about Roth. Should I invest in Roth? Should I convert to Roth? You know, that's an important decision, right? And we're going to be able to help strategize what the right decision for you and your family is. I'll give you an example, a personal example, right? Inside a 401k, these days, almost any company offers the choice between traditional saving and Roth saving, all right? Now, my decision, my wife and I's decision, was to invest all of our 401k money into the Roth portion, okay? So that means the money that I'm putting in there each and every year grows tax-free. And when we go to retire, say in 25 years or so, all that money that I put into the Roth is tax-free. All the growth is tax-free to me and my wife. Now, that may or may not be the right decision, but what that helps me do is it gives me a lot of clarity and predictability, knowing I'm going to have this bucket of money that's entirely tax-free to us, and we're not going to have to worry about what tax rates are 25 years from now, because we agree tax rates are on sale right now. Great point.
Yes, and I think we can all agree they're probably going to go up in the future. So, all right, we're going to take a very, very short break. We hope you go to onthemoneyoffer.com. It's really a wonderful, short, easy read. Brian is a great storyteller. We want you to get that. But you can also get an appointment for a complimentary consultation. And that means a review of your portfolio, a comprehensive review, and it means it's absolutely free. I'm Rebecca Powers here with Neil Major, sitting in for Brian Quaranta. Stay with us.
Market losses aren't the only risk in retirement. One of the biggest and most overlooked could be the tax bill on your qualified assets, your 401k, your IRAs, etc. As tax rates change, so does the value of your retirement income. A Roth conversion may help reduce your exposure and create more predictability. But timing and strategy matter. Want to see if a conversion could be a right plan for you? Take the Roth conversion quiz today. It's free, and it could help you make a more informed decision about your financial future. Scan the QR code on the screen or visit righttrackroth.com to take our Roth conversion quiz today.
All right, welcome back. Going right back to your questions, Pittsburgh. This is from George, who is 67. His wife, Emily, is 64. They're from McMurray, and their question is, our income is set, but we want to protect against large tax surprises. What's the plan?
Wow, good question.
Yeah.
So what would be a large tax surprise? Well, maybe one, required minimum distributions we've talked a lot about today, because when you hit your RMD age, you know, it's not, you know, a thought, it's an actuality. That's the money that you're withdrawing. Otherwise, you get hit with a 25% penalty for not withdrawing the money.
Oh, wow.
Right? So that's a little bit of a surprise. You should be planning for that. But you also have to plan for money that is maybe causing you taxation that you don't need. Okay, so what would be an example of that? Well, one is we love the fact that because interest rates went up, safe money is better. CDs, money markets, all those things have given us increase of earned on interest on safe money, right? But all of a sudden we get hit with a tax bill, right? So if we got $500,000 in an account that's paying us 4%, well, we're going to get a 1099 INT saying we earned $20,000. You got to pay taxes on that. Now that's important, especially when it comes to RMD age, because when it comes to RMD age, some of those surprises can catch you off guard, which can cause more taxation or maybe more Medicare costs. Other examples of that would be, well, if you have non-qualified investments that have dividends or interest that you're earning, or mutual funds. If you have mutual funds in your non-qualified, non-retirement investments, and the portfolio manager is making changes to those positions, redemptions, you're going to get a tax bill as well that can be surprising. So one of the most important things in your coordination of your strategy is making sure that you're kind of knowledgeable about all moving parts. That's a great question.
Yeah, it really is. Thank you so much for that question. All right, now we're going to Bridgeville. Tom and Sarah, we are longtime viewers, love the show. Thank you. Their question is, what's the best way to ensure our income plan does not run out of money if we live well into our 90s? We have longevity on both sides. Great question.
Great question. Great question. So probably the number one thing that they have to think about is developing an income strategy.
Right.
Okay, so just, a diversified portfolio is not going to be enough, because what we haven't talked a lot about today, Rebecca, is something called sequence risk.
Okay.
And sequence risk is simply when you are withdrawing money and early on the market's going down and you're withdrawing money, the sequence of returns is going to matter and potentially cause you to run out of money. An example would be, I always talk to this guy at my daughter's basketball games. He's in his late 50s, and he had told me he met with his financial advisor recently, and his advisor told him, well, he wants to retire. He said, it's really all about the first 5 years, whether you'll be successful or not.
I've never
and what
heard
he's
that.
talking about is sequence risk.
Okay, I was wondering.
And who would accept that type of strategy? You're going to the most important part of your life, something you don't get a second shot at.
Right.
And you're going to say, well, it might work out, but if the market's not good in our first 5 years, it probably won't work out.
And so what, go back to work?
Go back to work.
As Brian says, this is not a dress rehearsal.
Not a dress rehearsal. Yeah, so think about going back to work after 5 years too. All the technology that's in all of our jobs, you take off 5 years, you're not going back to work in any form or fashion in the same capacity because the technology has passed you by.
You sure? It's a terrible plan.
A terrible plan. So the most important piece for these folks would be to develop an income strategy.
Yeah.
Now, I love income annuities for longevity. So if you got great longevity, your goal is to beat the insurance company at their game. Now, I just had a friend of mine. She changed companies. So she had a balance in her 401k, about $200,000. They have a lot of stock investments. And what she said is, we have enough stocks. What could I do different with this money, Neil?
Yeah.
And so what we did, they're planning on retiring at 65, 45 years old right now. There's going to be a 20-year deferral. We bought them an income annuity. And in 20 years, that income annuity is going to pay them $48,000 guaranteed for life.
Per year?
Per year.
Wow.
Guaranteed. So even if the account balance goes to zero, the insurance company still has to pay the $48,000 each and every year. So essentially, we bought her a pension. Now, here's how I described it to them.
Yeah.
They're actually both in accounting. My buddy's a controller. She's an accountant. And how I described it to them is based on the 4% withdrawal rule, that $200,000 would need to earn 9.5% each and every year over the next 20 years in order to give them $48,000 a year of income based on the 4% withdrawal rule. Okay? Now, that's possible.
Maybe.
Right? Maybe. But remember, when you're talking about returns in the stock market, the numbers lie, right? That would be 9.5% like a bank CD.
Gotcha.
But remember how these companies calculate rate of return. It's different, right? So if I had $100,000 invested and I lost 50%, and then in year 2 I earned 50%, they report that as a 2-year average of 0.
You think you'd be back, but you wouldn't.
But, well, you picked it up, Rebecca. But you'd have $100,000 down to 50, you'd earn 50%, but you're only back to 75. So that's a minus 25 in my book, though it's reported as 0.
Yes.
Right? So the leverage, talk about leverage all the time, the leverage for them to be able to develop a $4,000 a month, call it pension, was incredibly appealing to them.
And the fact that you and everyone at Secure Money Advisors, you're an independent firm, means that you can shop every big insurance company. You can cherry pick what is best for you, Mr. and Mrs. Smith. That's so important. You've said the word personal pension. Okay, you don't have a pension, but you can create one. But not all annuities are created equally. My husband and I, after Brian's advice, we have 2 fixed indexed annuities, one for savings, one for lifetime income. Let's talk about the variable. Only 1 minute left in the show. Brian hates the variable. The word is varies. It doesn't truly protect your principal. Take it away. If you have a variable annuity, please call today to get second advice.
Yeah, and what's really interesting is you're right. Not all annuities are created equal. There are definitely bad annuities out there, but there's also good annuities. There's bad mutual funds, there's good mutual funds. Now, when annuities first came out, it was the variable annuity that came out. And as time has changed, when the fixed index annuity came out, about 10% was used in fixed index, 90 variable. Now it's flipped. About 90% of annuities bought today are fixed index. They can be some really good annuities that can help the outcome of your plan. But you do your part, folks. Pick up the phone, 888-382-1298, or go to onthemoneyoffer.com. We will help you coordinate a strategy with the outcome that you're focused on.
Thank you so much, Pittsburgh, for being with us. We love you. I'm Rebecca Powers here with Neil Major, and we'll see you again next time.